And the Russian central bank cut its key interest rate by 50 basis points on Friday, bringing it down to 16%. Now, the move comes as inflation slows, but the economy continues to struggle to grow. Now, central bank governor Elvira Nabiullina cautioned that it is too early to declare a victory over inflation, noting that sustained efforts are needed to reach long-term targets.
Inflation has been slowing down. In November, this deceleration was even slightly faster than we expected, which was associated not only with persistent, but also, to a great extent, one-off factors. That said, in the coming months, prices will be considerably affected by the VAT rise and the increase in administered prices. The resulting impact is yet to be estimated. We take all of the above factors into account when determining the pace and scale of the key rate reduction.
Rising food prices continue to strain Russian households. President Vladimir Putin acknowledged that while average inflation figures may be falling, prices for essential items like meat and poultry have risen sharply for many families. Now, speaking during his annual phone-in event, Putin emphasized that the central bank operates independently and is acting responsibly, while also noting that the economic slowdown reflects earlier monetary tightening and a price to be paid.
The goal was set to reduce inflation to at least 6%, but by the end of the year, it will likely be below 6%, 5.7%, 5.8%. However, the slowdown in economic growth is a deliberate step, the price paid for maintaining the quality of the economy and macroeconomic indicators. GDP growth is 1%, but if we take the last 3 years into account, overall growth is 9.7%. Meanwhile, growth in the Eurozone was 3.1%. Regarding this year's 1% growth, this is a deliberate move by the government, the central bank, and the entire country's leadership related to inflation targeting.
The war in Ukraine continues to weigh heavily on Russia's economy, limiting growth and keeping investor confidence low. Now, a potential peace deal in this case could open avenues for foreign investment, ease supply chains disruptions, and restore business presence in the country. Easing geopolitical tensions would also likely support stronger economic growth, reduce inflationary pressures, and allow for more aggressive monetary easing.